Good evening. My name is Stephen Beal, and I'm the principal at Beal Business Growth Consultants and Business Brokers. Tonight, we want to talk about exit planning, what you as a business owner need to know. This will be presented in two parts. This is part one, just an overview of exactly what exit planning is and what you need to think about. And part two, we will get into some of the key issues, including the financials and some of the tax issues you want to look at. So welcome to our webinar. So tonight's agenda is basically exit planning and succession planning. They're two distinct activities, and they should be thought of separately. Exit planning is a very high-level overview of all the different ways to exit your business. I have a colleague who has enumerated, I think, 17 different ways you can exit your business. We will try and simplify that for the purposes of this presentation, but it's a very, like a 30,000-foot overview of what are the different options that you have. So as part of the exit strategy phase, you look at all the different options and choose one based on what your goals and objectives are. And there's pros and cons, like everything in life, to going down different paths. Succession planning, by contrast, is a much more detailed plan. Once you've picked one of these paths, one of these 17 paths, you will have to start planning exactly how you want to go down that path. So it starts to get into the nitty-gritty of the actual succession plan, things like tax and legal, even training or insurance, or all the different issues that actually come into either selling your business externally or passing it on to a family member. Just to give a quick overview again of, I've boiled the 17 down into 4 so large categories, and the most popular one, as you might expect, is of course a family transition. So approximately a third of Canadian businesses are handled via a family transition. So the parents pass it on to their kids through one structure or another, and the business continues on in the family. The second most popular is a non-family management buyout. So this is where you take your business, there's no one in your family, your kids have grown and left and have no interest in the business. You take your key manager or a couple of key managers aside and say, hey, do you want to buy me out? And that is, as you can see by the pie chart, the second most popular method for someone to exit their business. So again, about 20 to 25% of the businesses are handled this way. The third most popular is an external sale. So this is where there's no one in your family is interested, no one in your management team is interested or able to buy your business. So you expose it to the market and you find a buyer. It may be someone you know, it may be someone you don't know. You sell your business to an external party, a non-family member, and someone who's not currently in your business. So that accounts for another 20 or 25% of the businesses out there. The fourth most popular, well, don't know if I necessarily call it popular, but the fourth way to exit is just a wind down. So you sell off all your assets, you pay off all your debts, you collapse the corporation, and you've got what's left over. And that happens, unfortunately, that happens in 15 to 20% of the time, where a business, maybe it's been good for you, it's helped you earn a living, but it's just not profitable enough that it can be sold for anything above the value of the assets. And we see that a fair amount in a number of different businesses that we work with. There is, if you notice, a little fifth sliver in there, and I put that in there just for people who are interested in IPOs or initial public offerings. Those are the ones where you've got a great idea, you've grown crazy, and then your company is worth billions and billions of dollars. as you might expect, those are the exception rather than the rule. If we look at these 4 broad options, and again, I'm trying to simplify down from 17 or more different options, but if we look at these 4 broad options and we sort of compare them by level of difficulty versus level of value you're going to get. Liquidation at some level, I mean, obviously it'd be hard and messy to sort of liquidate everything, but at some level, it's fairly simple. You're going to get the lowest possible value there. You're just going to get asset value. You're going to get 0 value for the goodwill of the business, but you'll get whatever the value of the assets are, minus, of course, the debts you have to pay off and the taxes that you have to pay off. And so it's fairly straightforward. I mean, you could liquidate within a matter of weeks, depending on the complexity of your business. You phone up an auctioneer, sell off all your equipment, and you're out of business. The next level, so it's a bit more complicated to sell to your family. You'll need a lawyer. You'll need to draft up the paperwork and do all that, financing, etc., and a whole bunch of other issues that we'll get into as we get into the succession planning side. But hopefully you'll realize a higher value, that you'll realize more the going concern value of the business rather than just the pure liquidation value. But I'm assuming if you sell to your family, you're probably not going to realize quite as high a value as you might if you sell to an arm's length management team. And so that's the next level up. As you imagine, if you're selling to a non-family member, the lawyers on both sides will be that much more diligent to make sure all the T's are crossed and the I's are dotted, and you may have more dispute over the overall value of the business. So there's going to be more negotiation involved from your point of view and their point of view. So it'll be that much more difficult. So again, ranked higher on the difficulty scale, and presumably you'll get that much more money than you would selling to your family. Finally, the most difficult is an external sale, and by external sale, I mean this is someone you don't even know potentially. So you've got to find them, you've got to bring them to the table, you've got to negotiate with them, and then the due diligence will be that much tougher because, again, if you're dealing with management, they at least know the business. They know the risks. They know the things that they're going to check out. The lawyer will guide them through the process. With an external sale, they may be totally unfamiliar with your business, so it'll be that much more work to get them to the table and to negotiate a good price. However, an external sale typically will generate the highest value. Obviously, circumstances may differ for a number of different reasons, but in general terms, this is sort of the trade-off that you face with these four different broad options. So might as well touch on recent experience. Obviously, we've just gone through, and we're still in the middle of a COVID pandemic, and that has taught us a number of things. Certainly, some businesses in the past year have been very difficult to sell. Any businesses that have suffered from a government-mandated shutdown, such as a restaurant or a gym or whatever, some of them were just basically impossible to sell at a reasonable price. Having said that, businesses that in the past year have been deemed essential, or businesses that are good, solidly profitable, and didn't really suffer as much as others, still continue to sell well. We've been keeping busy in the past year. There's been good demand for good, solid, profitable businesses. Businesses, again, that were either deemed non-essential and shut down, or that were just not ready for sale, either didn't sell or they sold for a lower multiple. Again, recent sales of strong businesses that were unaffected by the recent slowdown, and businesses that were negatively impacted have received lower multiples. So the conclusion for you as a business owner is that planning ahead pays. So if you are in the category of owning a business that has been negatively impacted by our recent environment, you may just want to wait. If you wait a year or so, it'll just help get one solid year under your belt, and that'll help with the sale of the businesses. You should also take a look at your business. If your business is weak or not, or marginally profitable, it may just be hard to sell at any time in the near future. So let's move on to the succession planning. As I said at the beginning, succession planning is the nitty-gritty of selling or transitioning your business. And as we get into the details of what needs to be done, some of the topics that we look at in a succession plan, a lot of obviously finance and transaction focus, like how much is a business worth? So that's a key question you need to understand in order to make some very basic decisions like, well, could my manager afford it? If your business is worth $1 million, maybe your manager can't afford it. If it's worth 10 million, maybe you really can't afford it. So you need to have a good sense of what is the business actually worth. Similar, you need to understand what are the tax issues. So what are the tax issues for you? If you're looking at a family transition, what are the tax issues they need to worry about? Obviously, legal considerations. On a personal level, what's your retirement plan? If you sell your business for X, is that enough to retire on? Do you have enough to retire on regardless of what you sell your business for? So what are you looking at personally from a retirement point of view? Obviously, the transaction details, how is the transaction going to be financed and structured? If you're selling to your kids, are you going to be financing them? If you're selling to your manager, is that an element that you need to look at? And insurance. You may want to take a look at your own personal insurance, but also insurance on, say, your kids. If they buy your business, what if they get hit by a truck? So you want to look at different levels of insurance for different potential risks. The other issues are more business focused, and these issues are important even if you're not looking at a transaction or a transition in the near future. It's important to look at how your business is going to run going forward. So do you have an ongoing succession planning system inside your business? If you have more than a handful of people, do you know what's going to happen if any one of them gets sick or any one of them quits? Do you have a plan for every level in your business if someone all of a sudden leaves you? What are the roles and responsibilities of the different players in this transition? They certainly need to be trained. Maybe you want your 18-year-old daughter to take over your business, but she needs to learn a lot before she can step into your shoes. So what training does she need between now and the time you're going to hand her the keys and you're going to sail off into the sunset? As you build out this schedule, you got to make sure you can follow the schedule. So you're monitoring that progress against the schedule. And if you have more than one child involved, you may want to look at a dispute resolution mechanism. What if your kids start fighting over how they're going to run the business or how it's going to be managed? So all of these things are important things to look at as part of an overall succession plan. So just touching on the different elements, if we are looking at a succession plan for a family, one of the key rules, I'll call it a rule of life, if you will, that you probably want to avoid infighting or acrimony. You want to treat all your family members fairly. So some of your family members may be buying in and others will not. So in that situation, you want to make sure that the people who don't buy your business are treated fairly somehow, so that they don't feel that they somehow have been cheated because they lost out on the business. If you have more than one child who is looking at buying into the business and working in the business, then it may fall to you to decide, well, who's going to do what? And so you may have to make the tough decisions, just like you would with employees. You're going to promote one over another. So how are you going to do that, and how are you going to communicate that in a family setting? I like to think of it as the Thanksgiving dinner test. Can you do make these types of decisions and stick with them and communicate with them without the whole family fighting and Thanksgiving dinner ruined for the next 10 years? And so if these are huge issues and you're worried about that, then maybe a family succession isn't the best option. Other issues to consider in a family succession is, regardless of who you promote and who you don't promote, how do you compensate them? I was working with one client and they had 4 kids all involved in the business. 2 were involved in management, 2 were on the shop floor. And the father thought, to be fair, everyone should be paid the same. Well, the 2 at the management level said, we can walk across the street and double our salary. We don't think that's fair. So it's a good question. How do you define fair? What is treating family members fair when you've got 4 employees or 4 family members and they all want to be treated, quote, fairly? With a management buyout, you may not have the family dynamics to worry about, but you have similar types of issues, one management versus others. So how do you choose amongst them? If you're in the luxury of having 4 or 5 or 10 good solid managers, and maybe any one of them would be a great person to buy the business, how do you choose? You probably don't want to approach all 10 of them, but so how do you choose which one? And again, you want to try and be fair with everyone involved. On the flip side, maybe you're not sure if your management team can do it. Are they able to run your business? And this is especially critical if you're going to take back paper, i.e. finance them. So if you're going to sell to your management team and they say, hey, I'd love to buy the business, can you lend me the $1 million it'll take to do it? You're going to have to think long and hard about that. Because your risk will be tied to them and how well they can run the business. It's not uncommon to have some form of financing from the owner in any of these transactions, but you want to make sure your risk is minimized. So that comes down to, how do you structure the transition, and how do you handle either an earnout or partial payments over time. Now, when you're selling to an outsider, so this person, I mean, it might be a competitor who's familiar with you and your business, but even with a competitor, they're probably not familiar with how you run things. But certainly if it's not a competitor or someone already in the industry, if it's a complete outsider who's looking to buy your business, you're going to have the greatest need to prepare documentation on the business in terms of how your business works, the operating manuals, detailed processes and procedures, a well-defined organizational structure, so when they walk in, they can understand how things work. And you also need to, since you don't know who the buyer is going to be, you need a marketing strategy for the business. So the first 2 options we looked at, the buyer was there. So whether it's family, it's your son or your daughter is looking to buy, or it's your management team. So someone on your management team is looking to buy. When we're looking at external parties, unless it's a competitor whom you already know, step 1 is to find the right buyer. And so that becomes a question of trying to figure out who the right buyer is, and the most logical buyer for your business, in terms of being able to add synergies. Like it may be a competitor, again, with some synergies involved. So who's the most likely buyer for your business? In situations like that, you've got to figure out what is the actual transition and sale process. So in terms of step 1, so before you decide, okay, what direction do I want to head in? What are your goals? So we're sort of taking a step back to almost exit planning, except we are trying to get into the nitty gritty. So what are your goals? What do you want to get out of this business business sale? Are you looking to maximize your profit? Are you looking to pass it on successfully to your kids? So take a look at your own goals, your family goals. Take a look at the marketability of your business. So how saleable is your business? Certain things are, as I mentioned earlier, the businesses that have suffered in the past year may be tough to sell, at least in the next year. As you assess the marketability of your business, you need to restructure and organize your business to make it more attractive. So this may involve things like if you have excess cash in your business or redundant assets like I don't know, like a Skidoo or something like that. I've seen weird things that people buy through their business, and so they'll own a Skidoo or a quad or a cottage or whatever. And so all those things need to be tidied up so that you can sell the business cleanly. As you prepare to transition or to sell, take a look at your business plan and your strategy. What you don't want to do is, as you're thinking ahead over the next 3 or 4 or 5 years, that yes, maybe I want to sell in the next 3 or 4 or 5 years, you don't want to start pulling back. If you're just sort of coasting and your business results show that the sales are declining and profits are declining, it's tougher to sell that business. Certainly it's tougher to sell that business for top dollar. The buyer is going to come along and look at it, and they're going to see revenue dropping and they'll see profits dropping. They're going to be concerned about that business, and it's hard to say to them, well, yes, but we used to do this 5 years ago. We used to make $1 million in profits. That's going to be a tougher sell than, yes, we're consistently making $1 million, and we've been doing that consistently for the past 5 or 6 years. So take a look at your business plan, your strategy. Make sure it's updated to the times. Take a look at your financial statements and recast them. This is part of the valuation process. We'll touch on that in part 2, where we look at people's financials and try and figure out what is the true value here by recasting the financial statements. And understand your true business value. So what is the worth of the business? What drives that value? I know we all want to sell for top dollar, and we all have in our mind what that top dollar is, but try and get a handle on what your business, how a buyer will see your business, and what that value truly is. In terms of the process, so as part of what we just mentioned, what's the most desirable exit strategy for you, and what's the most logical buyer? Whether it's your kids, whether it's a management team, whether it's an external buyer, how do you want to sell your business or exit your business? You need to prepare marketing documents for your business. This is part of what we do as business brokers, and a marketing plan. Make sure you can talk to a number of different buyers and figure out which ones are the most serious. As part of the process, we use what we refer to as a non-binding letter of intent in order to make sure we have agreement and broad principles before we go too far. Next step is negotiations and due diligence. So the buyer needs to understand your financial history and understand all the aspects of the business, the financial business, and also all the aspects of the non-financial factors that maximize the value of your business. Finally, as we get into deal making, what are the different financing scenarios available? Take a look at the different terms and conditions, and get your lawyer involved at this point to prepare the documentation, or to review the buyer's documentation. So no free webinar would be complete without a sales pitch. So just a brief introduction of what we do at Beal Business Brokers and Advisors. We advise people on buying and selling a business. We help people with business valuations. So we will do formal valuations if required for CRA or tax purposes, or for negotiation purposes. So we have a CBV on staff, myself, which is a chartered business valuator. So we are accredited to do business valuations across Canada. And so we do that for, again, for tax purposes or whatever. We also help people buy a business, review the different businesses out there. We also act as business brokerage and mergers and acquisition advisors for businesses ranging anywhere from a couple of $100,000 up to 5 or 10 million. So at the smaller end of the scale. We also assist in family transitions in all the different areas that I just outlined in terms of structuring, in terms of valuation, etc. Management transition, so the same thing. If you need a valuation to understand what is the right number, we also do business plans, financing plans, and strategic plans. Thank you very much for taking the time to listen to this video. Part 2 is also available, and that will get more into the numbers and the and what I meant by recasting in order to determine the value. If you have any questions, feel free to email me or go on our website and inquire through our website. We have all sorts of articles and links to other videos there. So thank you for your attention.